Replacing stocks with call options. The advantage is it takes less capital required to create a balanced portfolio. So if I only had enough money to buy, a few different stocks, well, I might be able to buy a full portfolio using options, using the call options, by buying these options, and I can choose the stocks that incur only limited losses when the market declines, meaning, you aren't going to get hurt when the market goes down, but if XYZ makes widgets and somebody else comes up with a better widget, that stock could go to zero, where you don't really have to participate on the downside when you're buying a call option. But you also get to take advantage when the stock rallies. The disadvantages are, if it's not done properly, the investor's portfolio will decrease in value because you're continually buying these call options that expire worthless because it's a sideways market. Say, for instance, Facebook. I keep buying calls in Facebook and they pretty much lose all their extrinsic value, and I lose everything through theta and volatility contraction, and I'm just kind of throwing money out the door, which makes it very costly to initiate. An example is you own XYZ stock and you have a nice profit and you want to protect it. You could sell your 100 shares, say at $38 a share, and then you would choose an option with a long duration. This is when you would be buying the long-term ones over a year, the leaps. You'd buy one in-the-money call option, say with a strike of 35, which gives you the right to buy XYZ at $35 a share. Remember, that $35 strike is going to have intrinsic value of $3 at least. And you're going to have a little bit of extrinsic value in there also, because nobody's going to do anything for free. So you're going to end up paying close to $38 per share. Replacing stocks with call options. You would use the longer duration call option as a substitute for the stock, which can allow the investor to create a more balanced portfolio and use puts and shorter duration calls to hedge each of those positions. So and you would use the covered call kind of strategy, or use a put to protect some of your long calls. When selling a shorter duration call versus a long position and a longer duration call, like a leap or one that's a couple of years out, it's also known as a poor man's covered call. The reason why it's a poor man's covered call is the guy didn't have enough money to buy 100 shares of Tesla and then hedge it. 100 shares of Tesla, you got to have deep pockets. But to buy 100 shares of Tesla using a call takes a lot less money. Still not cheap, but it's a lot less money.
Bulls can take control and push this up, or the bears take control and push this down to the 1400 level. That's what's going to be setting up for this week. All right? If you can't take that, take it easy.